So now that we have learned about cash flow from operations using the direct method, let us now focus on the indirect method of finding the cash flow from operations. So in order to identify what is the main difference between direct and indirect, we may want to kind of build the income statement again. It starts with sales. We have the cost of goods sold. What we get is gross profit, and then SG&A expense, selling general and administrative expenses. So we have EBITDA here, earnings before interest, taxes, depreciation and amortization. Then we have depreciation and amortization as an expense. We get EBIT, and finally interest. We reduce interest, we get EBT, and then taxes are reduced to find the net income. Now when we were talking about our direct approach, what we had used was that we had the income statement on one side and then we had the balance sheet. Now we required balance sheet for 2 years. We had seen an example where we required balance sheet of 2 years, 2010 and 11, and we had the income statement of 2011. With these two information, and assuming that the income statement is built on the accrual basis of accounting, the remaining portion which is not paid in cash is being reported in the balance sheet. So we identified the difference between the two and kind of reconciled and come to a conclusion that what would be the cash sales and cash COGS. So we could do that, right, because of the income statement accrual and also the positions of the balance sheet. Now we had done this line by line starting from the top. Now when it comes to the indirect method of finding the cash flow from operations, actually we start from the bottom. So net income becomes our starting point, and this is basically step 1 for the calculation of cash flow from operations using the indirect method. Now let us closely watch the income statement and identify some of the items which are affecting the net income. Say for example depreciation and amortization. This is basically a non-cash item. So if we are kind of considering for calculating the cash flow from operations, these non-cash items should be kind of added back. So step 2, you can assume that we need to add back all the non-cash items. So we are trying to find the cash position of the cash flow from operations, so we need to add back this into the net income. Now in addition to this depreciation and amortization, you will find that there would be certain non-operating items which are included here. Here the interest and the taxes are the operating items. However, an example of a non-operating item could be something like gain on sale of land. A land is a fixed asset and it needs to be classified as an investing activity. So if that comes here, sale of land comes in the income statement, this needs to be removed from the net income. So in order to negate the effect of gain on sale of land will have a positive impact on the net income. So we need to reduce. So if there is a gain, then reduce the net income by the amount of gain, or if there is a loss, then you can add net income by the amount of loss. So let us now compare these 3 steps which we have done with the direct method. If we consider the direct method, we look at the income statement one by one and had incorporated almost every expense and seen that from the point of view of cash or non-cash items. So this was step 1 for the direct method. Here if you look at step 1, 2 and 3, this has taken care of pretty much all items in the income statement. However, in direct method there was step 2 also involved, which involved the balance sheet items. So here, accompanied with sales, what we had also looked at was that the change in the receivables. Likewise in COGS we had seen changes in accounts payable within the balance sheet items. So if you consider these step 1, 2 and 3, this has taken care of the income statement items. We must now also consider the changes in balance sheet items that must be reconciled, and these balance sheet items will be essentially all the operating items. all the operating items which are found under current assets and current liabilities, we would also have to kind of take care of those set of changes and add this up to all the three steps above. So an example of current assets would be accounts receivables, inventory. Current liabilities would be something like accounts payables or accrued expenses. All these items needs to be reconciled. So step 1, 2, 3 and 4 cumulatively will provide us with cash flow from operations using the indirect method. So let us kind of go back to our original example where we had calculated the direct cash flow from operations, and let us now calculate for the very same example cash flow from operations using the indirect method.